The trouble with tech. Something strange is going on with the US tech sector CDS, or credit default swaps, something that we haven't seen since the global financial crisis. So what we're looking at here is the bonus chart from the weekly S&P 500 chart storm. I'll place a link to it in the description. So CDS are basically the cost of insuring against default or restructure of corporate bonds. They move and behave in a similar fashion to credit spreads. So higher levels indicate greater perception of risk of default and therefore greater requirement for a credit risk premium. It should be noted that the sharp move in this chart here could simply be a result of a routine order placed into a relatively illiquid market. But at the same time, it is not something to necessarily dismiss in the face of increasingly tight financial conditions, which can trigger off this sort of thing. Not to mention the downdrafts in the economy. And P.S., it is mostly myth that tech stocks are immune to the economic cycle. Sure, some companies will look cycle-agnostic when they are going through the rapid adoption and market share eating phase, but it doesn't take long for something that looks structural like that to become quintessentially cyclical. A key example would be digital ads. So online ads are practically the norm now. So aside from market share eating, it's all down to what's happening with the economy, business confidence, and most importantly, budgets in terms of what drives ad revenue growth. In that sense, we should expect changes in market opinion on credit risk premia for tech companies as the economic cycle sours. Particularly so for all those loss-making tech stocks that we heard so much about in 2020 and that people happily piled into during the monetary stimulus party of that year. These issues are echoed actually also in corporate bonds. So much like tech stocks, investment-grade credit got slammed by duration risk in the ongoing interest rate shock of 2022. But so far that pain in corporate bonds has been just that, duration risk or interest rate risk, rather than credit risk as such. But credit risk is the archetypal sleeping giant when it comes to bear markets. Awoken when monetary policy tightens, financial conditions seize up, and the economy gets crunched into recession. And looking at these charts here, and we'll just bring up the investment-grade credit one, you can see there that credit spreads are actually trending upwards. And so with that metaphor, the proverbial sleeping giant looks to be stirring. Definitely a good cause to keep an eye on credit. So if you enjoyed this video, definitely be sure to subscribe to the channel. But more importantly, go over to chartstorm.substack.com and sign up to the weekly ChartStorm write-up. That includes this here bonus chart. It's all free. Go ahead and sign up for that. I'll put the link in the description. And have a good week.